With markets widely expecting the Fed to keep rates higher, the focus is on the dot plot. For more on how this could shake up the markets and the best way to be positioned amid a patient Fed, let's welcome in Brad Neuman, Alger Director of Market Strategy. Brad, it's always good to see you.
Thanks for having me.
So tomorrow, Brad, what's going to be your focus? Is it the dot plot, the balance sheet, Jay Powell's rhetoric? What are you expecting?
Well, I think most people are going to be focused on the projections that the Fed has going forward. Whether it's 3 cuts this year or 2 cuts, there's certainly a risk that it becomes 2 cuts. And also whether the rates projections are higher in the future. So I think there's a decent chance that the longer run projection of interest rates may move higher, because I think it seems clear that what we thought was neutral probably has to be a little bit higher to put more of a dent in the economy, because the economy has been so resilient.
So let's say we do get those projections in and we only have 1 or 2 cuts forecasted for the rest of this year. How do you think markets are going to react to that? Because we've largely seen markets pretty consistent in pricing in 3 rate cuts.
I don't think there's going to be a dramatic move. 1 cut would be a bigger surprise, and that would, I think, be negative. But the market has shrugged off since late last year. They were expecting nearly 7 cuts, and now we're down to 2 to 3. So, and the market's digested that quite well, buffeted by enthusiasm for artificial intelligence. So I'm not expecting a huge reaction to something where it just tilts into 2 cuts instead of 3.
Brad, does the Fed need to cut for the market to move higher? That was a storyline, a narrative. You think that's still the case?
I think ultimately rates coming down is helpful. I mean, longer term, I think earnings can grow even if rates stay, broadly where they are, and I think the market could probably move higher. But certainly, rates coming down is what's expected, and I think what's needed for the next leg and kind of the short and intermediate term. And I think as rates move down, that's going to cause a change in market internals and dynamics within the equity market.
Brad, there has been a lot of talk when it comes to a no landing versus soft landing scenario. Considering where we're at with interest rates, where we're at with inflation, which camp are you ultimately in right now?
I think that the economy will weaken a little bit from here, but recession seems like it's off the table now. You saw housing starts being reported. The housing market seems to have bottomed and has been coming back. And manufacturing even may be coming back to some extent, and that leaves the consumer, and the consumer's proven awfully resilient.
There seems, Brad, to be this kind of growing chorus that maybe we're due here for a pullback, call it 5 to 10%. If you saw that, Brad, would you be a buyer on that weakness?
Well, I think there are some very attractive parts of the stock market right now, particularly the stocks that have gotten beaten up by rising interest rates. So, we've seen a very high negative correlation with small cap stocks, small cap growth in particular, and interest rates. It's been like a negative 85% correlation over the past few years. And they've gotten extremely cheap. They used to trade at historically kind of like a 10% premium to the broad market. Today, small cap growth stocks are trading at like a 20% discount on a price to earnings basis. So that area of the stock market seems to present some attractive opportunities in my view.
So bullish on small caps, and we have seen this pullback more broadly in the Magnificent Seven. What other areas of the market do you think there are opportunities when we look down the line and where the Fed could potentially move?
Well, when I was on the program in early 2023, we talked about AI and the infrastructure AI plays there, like hardware, NVIDIA, and software, Microsoft. And then when I was on late last year, kind of broadened that out because there was a lot of enthusiasm for AI, and we talked about kind of tertiary AI plays like power and those kinds of things. And now we still like AI, certainly for the long term, but the sentiment is fairly robust there. And so I'd be looking at some other themes.
What, Brad? What would be on your radar?
Yeah, like alternative asset managers. So here I'm talking about the public equities of companies that invest in private equity. And the case for these stocks is that institutions like pensions and endowments have like a 20 to 30% of their allocation into privates, but the mass affluent in this country have about a 3% allocation. In fact, just recently, this week, CalPERS announced they were going to 40% private markets allocation. But anyway, every move from that 3% up, like if they went from 3 to 4% for within the retail market, that would be like a 15% growth in AUM for this market. So I think there's big growth potential for the likes of Hamilton Lane and Stepstone. They've made some really good innovations. They've allowed the private market they've allowed retail to get into the private market with much lower minimums than we typically see, like $50,000 type minimums, and also having monthly liquidity. So I think those innovations may open up the retail market to private equity, and that could be a boon for those types of stocks.
What about, besides AI, certainly one of the hottest trends investors are focused on, pharma. I'm just interested, any kind of examples there? I think there were small, maybe, and large cap names, Brad, you were interested in?
Well, of course, we think GLP-1 is going to extend its indications for use for different potential disease states. And so, we own Eli Lilly and abroad, Novo Nordisk. So still think that's an interesting play longer term, yeah.
And when we think about risks to the market longer term, obviously outside of inflation and what the Fed does with interest rates, we have the election cycle coming up. Do you expect that we'll see any more volatility as we head closer into November?
Yeah, historically, the market gets nervous leading up to the election and then begins to do well post the election. So I could envision some turbulence, particularly as more gets to be known about potential policies. But what we've published in the data that we've seen historically is that what the market envisions as being the beneficiaries from different policy moves don't really come to fruition. So, for instance, when Trump was elected back in 2016, a lot of people thought that the lowering of corporate tax rate would benefit kind of domestically oriented companies. And they did well for a little while, but ultimately kind of over the 1 and 2 years post the election, they actually lagged. And what we did see well was innovative companies, types of companies that Alger invests in. Similarly, after Biden was elected, people thought that solar would do really well. Obviously, he ran on kind of an environmental forward type policy. And those stocks initially were very strong out of the gate and then began to underperform and didn't really have a lot in the tank over the medium term there. So again, innovative stocks outperform. So at Alger, we set our focus really on innovation and who's going to win from that innovation within industries rather than betting on policy changes.
All right, makes sense. Brad, thanks as always for joining us. Appreciate it.
Thanks for having me.